When the financial crisis struck in 2008, the world's biggest central banks all ran to the rescue, and the biggest rescuer of all was the US Federal Reserve. By law, the Fed has to worry not just about inflation, but US jobs. It's kept short-term interest rates at just 0.25% since the end of 2008, and despite a growing economy, it says it doesn't want to start raising the cost of borrowing while the US unemployment rate is above 6.5%. To keep the recovery going, the Fed's also embarked on rounds of quantitative easing, when it creates hundreds of billions of dollars electronically, then uses that to buy financial assets such as US government bonds or IOUs. Right now, the Fed's injecting $85 billion into the economy this way each and every month. That's the equivalent of more than $1 trillion a year. The chairman, Ben Bernanke, said in May he expected the cash injections to continue until the middle of 2014, when he expected unemployment to have fallen to around 7%. But the Fed's looking to lower or taper the monthly dose well before that, in the latter part of 2013. The problem is those emergency cash injections haven't only been affecting the US. They've helped keep the cheap money flowing around the world, including the struggling Eurozone and the fast-growing emerging market economies like Brazil and India. Talk of the taper has pushed up the long-term cost of borrowing there as well, and global investors have been pulling money out of emerging markets on fears that these countries will get into trouble without all that easy money flowing out of the Fed. The good news for the world economy is that America's healthy enough to think about weaning itself off the drastic medicine the Fed's been administering since 2008. The bad news is that the rest of the world must begin to fend for itself as well, and many investors aren't sure it can.